All right, hello everyone, and welcome to Escaping the Trap of Concentrated Wealth, 3 Diversification Moves for 2025. My name is Johannes Kramlet, and I'm here with my lovely wife, Lisa Kramlet. She's my partner at Kramlet Capital. We're really excited to have you joining us today. So if you're in the tech, sales, fintech, or SaaS, this session was built for you. Because the truth is, most of us in the industry have our financial lives completely tied to our companies. Our income, bonuses, all of our stock all depend on the same source. And when things are good, it feels amazing. But when the market shifts, it can wipe out years of paper wealth overnight. So I've lived that firsthand. And when my company went through a major reorg, my concentrated position cost me $500,000. And that's what pushed me to start building a more resilient portfolio. So today I'm going to walk you through the 3 diversification moves that help me cut my risk, create passive income, and finally gain financial peace of mind. Moves that anyone in this room can start applying in 2025. Before we dive in, I'll give you a quick background on me. We'll look at our track record so you can see what kind of investments we focus on and why diversification has become such a game changer for our investors. Okay, so my name is Johannes. I'm the founder and CEO of Kramlet Capital. I'm also the chief investment officer, and I spent 20 years in technology sales as a senior vice president of sales and a sales trainer. And about a decade ago, I realized that true wealth, time, and financial freedom wouldn't come from a paycheck, especially when I was paying nearly 55% in taxes. So I started investing in real estate in 2022 passively, right, while still working a full-time job. But by partnering with experienced operators, I was able to generate strong returns without managing properties myself and ultimately retired 7 years later at 43. Today, I serve as a CEO and chief investment officer, helping investors like you pull capital into institutional quality real estate opportunities not found in the public markets. So I'm also a chartered alternative investment analyst, and I've led over $1.5 billion in commercial real estate transactions. On a personal level, I'm an immigrant from Ethiopia and just have deeply grateful to live in a country where anyone can build wealth through real estate, regardless of their social, economic backgrounds. I'm also a mentor to at-risk youth through the Orange County Boys and Girls Club because wealth isn't just about freedom, it's about impact. And I'm very passionate about financial and time freedom, okay, and helping others achieve the same. All right, so today, our purpose is very clear, as I mentioned, is to help others achieve the same time and financial freedom that Lisa and I enjoy. For us, freedom means doing what we love with the people that we love when we choose to do it. Whether that's traveling, adventure, or simply being present, okay, that's what real wealth is all about for us. There we go. Now, at Crown Capital, we specialize in private real estate, as I mentioned earlier, the kind that typically are off limits to the public markets. Today, we've deployed investor capital across 13 properties, representing over 331 million in assets under management. That's both with us and our partners, in partnerships with institutional grade operators, right? So people who are at the BlackRock level. Okay. We've worked with thousands of investors deploying over 132 million in capital into these opportunities. And on the investments where we've gone full cycle, we've delivered a 32% annual rate of return and a 2.7 equity multiple, meaning that we more than doubled investor capital, almost tripling it in some cases. And for our investors, these investments are 100% passive. So no tenants, no toilets, just professional execution and real ownership. So we combine decades of experience, responsible capital management, and that really is just about having a disciplined approach, rigorous vetting process, and making sure that our values are always aligned with the people that we work with. And that's transparency, consistency, and accuracy in everything that we do. Okay? All right, let's move on. So our team, uh, considers investment analysis led by myself and Dolph Renault, the CFO. Only 2% of the opportunities that we analyze make it through our stringent requirement, and we look at some 200 opportunities in any given year. So when you see an investment from us, it's the best of the best and very highly vetted. Lisa and Isaac are our investment relations team. They ensure transparency, consistency, and accessibility to our investors at every stage of the process. Okay. Today, we don't just invest in any market, we're highly selective. Before we even consider looking at a property, we focus first on finding a landlord-friendly state with strong population and job growth driven by business-friendly tax incentives that result in diverse employment base and economy, making it resilient to resilient in times of economic downturns. Then we target submarkets with solid income levels, high renter populations, and strong institutional investor activity, all which creates a very healthy pipeline for both acquisition and exits. Okay, so here's what we're going to cover. Whew, got through that. First, we'll talk about the concentrated wealth trap, what that means, why so many tech executives and sales leaders have 50, 60, even 70% of their portfolio of their net worth tied to their company stock, and how that creates a hidden risk. Then I'll walk you through the three diversification moves that help many of the top performing executives that we work with are using to shift from fragile stock heavy wealth to a more resilient cash flowing portfolio. First, we'll talk about reducing your stock concentration without sacrificing growth. Then we'll talk about move two, how to leverage tax advantage investments, the same tools that the very wealthy use to keep more of what they earn. Move three, how to build multiple streams of income that pay you whether or not the markets are up. And after that, we'll look at what I call the new investor playbook for 2026, how today's professionals can protect and grow their wealth through smart diversification and alternative investments. Then I'll share a real case study so you can see how all this works in action. And finally, I'll show you how to get involved if you want to start building your more resilient portfolio with us today. Okay. Next. All right, concentrated wealth. There we go. What is it? So let's define what actually means, what I actually mean by concentration risk. I think Ray Dalio says it best. If you're mostly invested in one thing, you're not diversified, you're exposed. And what he's talking about, let me move my face here. And what he's talking about here is correlation. Most people think diversification means owning more stuff, a few different funds, maybe some tech stocks and 401k. But if everything you own moves in the same direction when the market swings, that's not diversification. That's just exposure. So diversification means your investments don't move the same way when economic conditions fluctuate because they're uncorrelated, they're unrelated, right? They're not moving the same way. In the tech world, this problem is magnified. Many of us have our income, bonuses, 401k, stock grants, RSUs, etc. Essentially, all of our net worth is tied up to the same company, right? And of course, all tied to the same stock market, which that when that one company slows or that market slows, misses in earnings or does a cutback, your career and your wealth both take a hit at the same time. That's concentration risk. And it's a silent thread hiding in a lot of high earners' portfolios. On the next slide, I'll show you how I learned that lesson the hard way. Okay. So over 60% of technology sales leaders and executives have more than half of their net worth tied up in employer stock. That's what you see here in this chart with the big pink slice. This represents company stock, and the small blue slice represents everything else. According to T. Rowe Price, anything over 15% of your net worth tied to one company creates a high exposure risk. And I can tell you from experience, they're right. Okay, when my company went through a major reorg a few years back, my concentrated position cost me $500,000 overnight. That's when I realized that what I thought was financial security was really exposure to disguise as success, right? I was exposed. I used to call it IPO whiplash, that roller coaster feeling of watching your net worth spike on paper, then fall just as fast when the markets or company fortunes shift. It's thrilling when it goes up, but devastating when they turn. So that was my wake-up call to start diversifying smarter, because financial freedom isn't about how fast you grow your wealth. It's about how well you protect it. Okay. So now let's dive into the three diversification moves many of our clients are doing in 2025 to reduce concentration risk. Move one, reduce stock concentration. Okay. Here's the reality. Like as I mentioned, most tech execs, 60% or more, 60% or more of their net worth tied to employer stock. This is according to Schwab Equity Compensation Study in 2022. There we go. And on paper, that looks great when the stock is climbing, but it's fragile wealth. One earnings miss, one round of layoffs, one market correction, years of wealth evaporate overnight on paper. Okay. Now, in this thing, I show you portfolio A. This is what I see all the time. 80% of wealth in a single stock, right? We have a guy who is with Amazon, and he's at very high level I'm sorry, with Google. He's a very high level executive, and 80% of his wealth is tied into single stock, 10% in cash, 10% in his home, right? That's not diversification, that's exposure. And it's a reason why someone making 500,000 a year can still lose half their wealth in a layoff. It's very easy, okay? So fact, between 2021 and 2022, the Nasdaq lost 35% of its value, with a single company stocks like Meta, Netflix dropped over 60 to 70% from their peaks. If 80% of your net worth is employer stock and a 60% drawback drawdown cuts that portion in half on 1 million tied up in stock, that's $600,000 paper loss. Ouch. Okay. Compare that to portfolio B. Here, you're still in the market, but 40% in stock, 20% ETFs and funds. But you've also allocated 30% to private real estate equity and private real estate credit, and 10% in cash. Okay. The outcome: you're no longer betting on your future on a single stock ticker. In fact, this is how the wealthiest investors already think. According to Knight Frank and Pequin, ultra high net worth portfolios, right, allocate roughly 25 to 30% to private real estate and alternative assets, not for higher returns, but for stability and consistent cash flow. Okay. In the same downturn in 2022, multifamily real estate generated positive cash yields of 4 to 6%, okay, according to NCREIF, while private credit funds returned 10 to 12 annualized, right? This is according to PitchBook in 2022. So diversified portfolios, a mix of stock, real estate, alternative assets, historically have 30 to 40% less volatility than the stock heavy portfolios, while long-term returns are very similar. And this is according to the Dalbar Q&A study in 2021. So the key insight here is that this isn't about lowering returns. It's about smoothing out the ride. A diversified allocation gives you the same compounding potential, but without the gut-wrenching volatility that keeps you checking your portfolio at midnight. Fragile wealth is risky, right? Resilient wealth means your retirement isn't tied to one company's next earnings report. So portfolio B shows you don't need to gamble your retirement on a single outcome. Diversification gives you the best of both worlds, yield and peace of mind. All right, now let's talk about tax-advantaged investments. Okay, that's diversification move number 2. Okay, so when evaluating investments, it's not just about chasing returns; it's about balancing returns, tax treatment, and the effort that you have to put in. So this chart shows how different asset classes stack up. So in this chart, we track average annual returns in the x-axis, horizontal, and tax treatment in the y-axis, right, the vertical. So in quadrant 1, we have crypto, right? Crypto can deliver massive returns, 20% plus in bull cycles. I've even seen higher. But it comes with very high volatility. No tax benefits as they're taxed as capital gains, right? The highest capital gains possible. And it takes consistent monitoring. Okay, so for most investors, this is speculation, not diversification. So in sector 2, you'll see bonds. If I can move myself there we go. You'll see bonds. Okay, bonds average 3 to 6% a year. Some are a little bit higher, some are a little bit lower. They're low risk, very low effort, but also low reward. And income is taxable, so you don't get much tax leverage from these you don't get much leverage from tax benefits. Excuse me. So now we move over to quadrant 3. Okay, so you'll see 3 other very common investment vehicles, including public REITs. So REITs deliver 4 to 6% returns and move with stock market volatility. Okay, you're not investing in real estate in a real estate investment trust. You're investing in the stock, right? They're easy to own, but the dividends are often taxed at ordinary rates. So you don't get the same tax advantages as private real estate. So if you're a high income earner, your dividends are taxed at your income rate, whatever your ordinary income rate is. And for mine, it was very high, at the highest. Okay. We also have stocks and index funds in quadrant 3. Stocks average 7 to 9% long term, right? Conservatively, but they build wealth for decades, but the risk is high. And there's no real tax benefit unless you're in a retirement account. So many in tech, this is where your wealth is already concentrated, right? And so you're already here in this sector. Okay. Then you have single family rentals, also in quadrant 3. So rentals average 8 to 12%. When you combine appreciation and cash flow. The tax benefits from depreciation are strong, but the effort is high. tenants, toilets, turnovers. Make this an active investment, right? It's you who's responsible. It's another job, right? Or you're paying somebody, which cuts into yields. In quadrant four, we have private real estate. This is what I call the sweet spot. Okay, you're getting the best of both worlds. So syndication has returned 14 to 18% historically. These are assets. These are asset backed, so less correlated with the stock market. The big advantage is the tax treatment. Depreciation often shelters, typically shelters all of the cash flow, and when paired with 1031 exchanges, the growth compounds the tax deferred income. So best of all, they're fully passive. So you capture the returns without adding an extra job. Okay, so this is the sweet spot. High returns, great tax benefits, and completely passive. So when you map it out, most investments force you to choose safety, returns, or tax efficiency. Syndications are unique in that they sit in that sweet spot. High returns, strong tax advantages, and no added work. That's what makes them so powerful for high income earners looking to protect and grow wealth. Okay, now let's see how this plays out in real life. So imagine you're an investor and you put $100,000 in a real estate syndication. Every 3 years, you exit and you reinvest. You're achieving a 2x equity multiple in each exit, right? So each time you exit, you're doubling your money and you're going to the next investment. So in the first scenario, without any tax treatment, that's this guy in red here, and I'll slide myself over. That's this guy in red here, right? The investor pays capital gains and depreciation taxes at every exit, right? So here, 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 and here. Okay, that means they only reinvest what's left after taxes, roughly 80% of their gains each time. Okay, so they're leaving 20% on the table. In the second scenario with the tax advantages, the investor leverages depreciation during the hold to offset the passive income, so they got that money, no taxes, and use 1031 exchange at each sale to defer taxes completely. That allows them to roll forward their investment the full 100%. So the 1031 allows you to roll over into the next investment, allows you to put the whole 100% in there into the next deal. So after 12 years, right, so you see, he continues to just double his money every single time. So after 12 years, the path looked very different. The investor who didn't use a tax strategy ends up with a little bit under 900, just under $1 million. Still very, very good. But the investor who did use depreciation 1031 exchange ends up with roughly 1.6 million. So same initial 100,000, same returns, same timeline. The only difference is what they did with their tax treatment. That's an extra 600,000 in wealth created purely by smarter compounding, not higher returns, just keeping more of the money working for you instead of handing over 20% to the IRS at the exit. Okay. Now, what I love about this the most, and that we don't talk about it often, is that it is a deferral of both the capital gains and the depreciation recapture. But if you continue to do this and you never break the cycle, what happens is when you die, you can do a step up in basis. And what that means is that you can basically hand this to your heirs and there'll be no taxable events, right? And passing that down to your heirs tax-free. That's generational wealth. Meanwhile, while you're using this strategy, that cash flow keeps coming into your pocket every single month, right? So you're compounding your equity faster and you're compounding your cash flow faster, and you're actually getting the benefit of that cash flow. So that's what's really amazing about these assets. So now let's talk about building step 3, which is building multiple income streams, my favorite, okay? So when it comes to building multiple income streams, there's a couple things you need to consider. I'm gonna move myself over here. Cash flow, does it generate reliable income, monthly or quarterly, whatever it is? Is it reliable, predictable income? Time, is there a lot of effort in this new endeavor? Diversification, does it reduce reliance on one stock or one employer or one sector, right? And then tax benefits, are there meaningful tax advantages? So let's look at these 3 example income streams, okay? A lot of when most tech leaders think about building a multiple income stream, they usually start with one of these common paths. So first is consulting, freelance work. That you can generate some extra cash flow, but it comes at the cost of your time, right? You're basically trading one job for another. And that income is taxed as ordinary income at the highest tax bracket. If you're someone like me who was in that high tax bracket, it hurts. It's additional income. It even pushes you that additional tax bracket. So that's why I give it a few stars for cash flow, but very low for tax benefits. Second, startups or angel investing. This feels exciting, but it's very high risk. Most startups fail, and even the winners don't generate income for years. So you've tied up money into with no cash flow, high effort, and almost no tax advantage. That's why the star ratings are very low. Okay. Three, you have side businesses like SaaS products, e-commerce, or content creation. These can work, but they require enormous time and energy. And again, they're creating another job, not building passive income. That's why I scored the medium on cash, but very high on time. Fourth is employer stock or equity. Okay. This is the default for most of us, right? In tech. So here's the issue. It doesn't produce cash flow. It's all paper wealth. It's concentrated in the same company or portfolio or group that pays your salary. That's fragile, right? That's not diversification. So finally, we got real estate syndication, multifamily specifically. This is one that's the strategy that scores high across every category. Strong cash flow every month, almost no time required. Real diversification because rents don't move. It's lockstep. Okay, so rents don't move in lockstep with tech stock, and the tax benefits are unmatched. You just can't get that anywhere. Depreciation and 1031 exchanges allows you to keep more of your returns working for you. That's why syndications light up the board compared to everything else. All right, so let's just talk about the new investor playbook, right? Let's bring it all together. So, how do you actually start moving fragile wealth to resilient wealth? Okay, it begins with small intentional steps, not a total overhaul. Number one, rebalancing your portfolio. Start by trimming your concentrated positions. Your 60 or 70% of your net worth lies in your employer stock. Look for opportunities to sell a portion of your RSUs or vested options as they become liquid or as when you can. Even shifting 10 to 20% into uncorrelated assets can dramatically lower your risk profile. Okay. Step two, relocate gains. Use these proceeds, right, from your rebalancing to buy assets that work for you, things that create income and stability. For many tech professionals, especially the ones that we work, they're investing in private real estate syndications or private credit funds. These asset classes generate consistent cash flow and aren't tied to the same market cycle as your employee stock plan or stock options. Three, leverage tax strategy. Don't just earn more, keep more. Use depreciation, 1031 exchanges where possible, or consider tax advantage accounts like self-directed IRAs if you have an old, and allocate that to real estate. So if you have an old 1031 exchange, you haven't optimized that, roll that into a 1031, right? Start taking advantage of that. I'm sorry, into a self-directed IRA, start taking advantage of that. Number four, build multiple income streams. The goal isn't to quit your job, is to make sure your livelihood doesn't depend on your job. So when your investments pay you every month, you're not chasing the next bonus to feel secure. This is how modern tech professionals are building freedom. One RSU sale at a time, smarter reallocation at a time, right? One smart allocation at a time. So let's look at a case study of what this looks like in real life, okay? So here's an example of what this kind of a real estate allocation looks like in real life. So this is MFI Sunridge, a 200 unit multifamily property in Charlotte, North Carolina that we did earlier this year. We purchased it for $31 million, which was roughly a 20% discount compared to other properties in the same market. Okay, it came in comparable properties in the market. It came from a legacy owner who held it for 25 years, hadn't kept up with the management or renovations, which gave us a real opportunity to create value. They did keep up on maintenance though, which is great. So our plan was simple: renovate every unit, add washers and dryers, modernize the exterior, improve the operations, and within the first 30 days, we were already generating enough income to pay the investors their first cash distribution, 1 month ahead of schedule. Now, to be clear, we're always buying cash flow properties. It needs the cash flow right away, but we were able to not only buy an asset that was cash flowing, but we were able to implement some quick strategies, just really exterior renovations and cleaning up the operation that gave us more than enough income to be able to give a distribution earlier than planned, okay? Earlier than planned. So the property is currently projected to produce 5.4% annual cash flow with a projected 20% annual rate of return and a 2x equity multiple over the 2 to 5 year hold, okay? On top of that, the deal delivered significant tax efficiency. So investors who were investing received 45% of their investment in depreciation. So if you invested 100K, you could have taken roughly 45,000 in paper losses against your passive income, okay, which is amazing. We also made it available to investors using a 1031 exchange. That means If you had another property and you were selling it, you could roll those gains into this deal and defer taxes while immediately starting to earn income and benefit from your depreciation again. That's huge. Okay, so not only on the exit, but they were getting it on the entrance into the deal. So this is what private real estate investing looks like in practice: steady cash flow, strong upside, smart tax treatment, all in asset that doesn't ride the same roller coaster as the stock market, right? Completely uncorrelated. So very proud of this deal. So if today's session resonated with you, and if you're realizing this time to move from single stock, from a fragile stock heavy wealth to more resilient, diversified portfolio, here's exactly how to take the next step. Step one, schedule a call. Scan the QR code you see there, and I'll give you a second to do that. That sets up a short investor strategy call with me and my team. It's a chance for us to understand your goals, talk through your situation, and see if what we do aligns with what you're trying to build. Step two, get qualified. We'll walk you through a few quick questions. Make sure you meet with the general SEC requirements for private investments. That step gives you access to opportunities that aren't available to the public. Okay. Step three, partner with us. So once you're qualified and you feel comfortable and you've learned about us and we know about you, you have a chance to invest alongside us in carefully vetted multifamily projects similar to MFI Summers, the same types of income producing assets that we've been discussing here. So it's not about handing your money over, right? It's not about that. It's about learning to invest like the wealthiest families do: stability, cash flow, and confidence. Okay. So I'm going to wrap it up and leave you with this thought, right? Financial freedom isn't about chasing your next IPO or watching your RSU spike on paper. It feels great, but that's not what it's about. It's about building wealth that lasts, that isn't tied to one company's performance or one market cycle or even one sector, right? True diversification with uncorrelated assets. Today, what we covered is diversifying out of the stock, leveraging tax efficiency, and building a multiple streams of cash flow. It's not theory, it's exactly what I did and what so many high income professionals are doing to create real stability in 2025 and beyond. So if this resonated with you, scan the QR code, reach out directly or to me. You can call me on my cell phone here or email me. Let's talk about how you can start shifting from fragile wealth to resilient wealth, one smart move at a time. Okay. Hey, thank you for spending part of your day with me. Hope this gave you clarity, confidence, and maybe even a little peace of mind about your next steps. I'll see you in the next Financial Freedom Workshop. Thank you again.